Last year, other investments are down by 10 to 15%, but gold in Australia is up 5.5%. Now, by my calculations, if you hold currencies in a bank at 3 to 4% interest, and that means you are losing 10 to 12% because inflation is not 6%, but more like 16%. So you can't look at inflation at 6% because they take out food, energy and real estate out of the inflation figures. Well, you can't live without food and energy, and you can't live without a food overhead. So if you are losing money with cash in a bank account of up to 10% a year, do you agree with me that in this environment, through high inflation, that everybody should own as much as they can?
I think I'd put it slightly differently. Just try and sort of work out for yourself the likelihood that the fiat currency system is in mortal danger, if you like. That should set your preferences, I think, in terms of where you allocate your cash liquidity. I mean, you're right to point out that in effect, which is what you were saying, is that the point about having, whether it's gold or cash or whatever, is a temporary ownership of liquidity, which you will convert into real assets or spending or whatever it might be. It's not something that is necessarily hoarded. But in these extraordinary times, gold and silver is being hoarded. You could say actually that gold and silver is always hoarded in the sense that Gresham's law says that it's the superior form of money. Well, it's the only form of money, as we know. And what you do is you spend your credit instead. So you hang on to the money, but you spend your credit. But it's really the level of the hoarding, if you like, of gold and silver that we're talking about. And it's my view, and it's a researched view. It is a thought out view. The whole of the global fiat currency system has enormous challenges ahead of it, which are likely to destabilize it. Now, under those circumstances, I would own as much gold and silver as I could afford, and bearing in mind that it's also liquidity. So when if I have an unexpected call on my resources, I don't have to go to the bank and say, can I have a loan, please? Or I don't have to draw down my credit cards because I've got a store of gold and silver, which I can liquidate in order to cover those unexpected demands placed on me, whether it's by the tax man or whatever it might be. So it is essentially, if you like, that form of saving. Now, a lot of people will turn around and say, well, yeah, it's all very well saying saving, but it doesn't pay you any interest. Now, this is actually quite a hurdle, intellectual hurdle for people to get round. I mean, the reason it doesn't pay any interest is because you should be comparing it to, folding notes. That doesn't pay any interest either. You can, if you wish, lend your gold to someone else for interest. The interest that you get in it will be a lot less, or should be under normal circumstances, a lot less than you would get by lending an equivalent value of currency. But that is a reflection, if you like, of the stability of the purchasing power of physical gold, physical silver, compared with, central bank or bank credit. So the interest rate argument actually, when you look at it, doesn't actually cut any ice at all. And I would add to that also that in the 1970s, when Nixon stopped the Bretton Woods Agreement, around about that time, Fed funds rate fluctuated between 3.3 and 5.6%. At the end of that decade, we saw the gold price rise from, it had been revalued to $42 an ounce, 42.22. We saw a gold fix, and I think it was January 1981, of $850 an ounce. At the same time, the Fed funds rate had risen to 14%. So the idea that interest rates work against gold is plainly rubbish. I think it does in an environment where, if you like, the sort of the people dealing in the investment community take the view that inflation isn't a problem, or it's not a problem that they should regard as anything more than temporary. In which case, they will look at they will look at the interest rate that you lose by holding on to a gold position. But as soon as you actually realize that inflation is a problem, then your attitude must change. So I think what we can conclude from that is that financial markets do not actually take the inflation problem seriously at all. And that is an interesting conclusion, because at some stage, I think they will. And then the whole relationship between currencies and gold will actually change quite sharply. You'll find that we'll be back, at the very least, looking at the 70s situation where even though you got a rise of multiples of the Fed funds rate, gold price still went up. So, as to your question, I mean, it's for every individual to make up their own mind about how much gold or silver they should have. But I would also add to that legally, gold is money. So is silver. It's just that silver isn't recognized by the central banks as money. And all the rest is credit. All the rest is credit. So you have counterparty risk with credit. You do not have it with physical gold and physical silver.
I cannot believe that gold is so misunderstood. I really can't. I mean, I keep on giving illustrations, Alasdair, with reference to gold versus real estate. And gold is so far ahead. I sit in front of accountants, financial advisors, and I highlight how good an investment gold has been over since 2000, the last 22 years. And they just can't believe it. Their jaw drops and they just can't be.
Alasdair Macleod delves into the nuances of gold investment and its relationship with inflation, offering a detailed analysis of the current economic landscape. He begins by noting the contrasting performance of gold compared to other investments, with gold in Australia showing a notable increase while other assets are down by 10 to 15%. This leads to a discussion on the impact of inflation on traditional bank interest rates, where Macleod calculates that holding cash in a bank can result in a significant loss of 10 to 12% due to inflation rates that may be higher than officially reported. The conversation evolves into a broader consideration of the role of gold and silver as hedges against inflation and economic uncertainty. Macleod argues that in times of high inflation, it becomes essential for individuals to diversify their portfolios and allocate a portion towards assets like gold and silver. He emphasizes the historical precedent of gold's performance during periods of economic instability, citing examples such as the 1970s when gold prices soared despite rising interest rates. Furthermore, Macleod challenges the common perception that interest rates are inherently detrimental to gold investments, pointing out that this view is contingent on the belief that inflation is not a significant long-term concern. He suggests that financial markets often underestimate the severity of inflation, leading to undervaluation of gold as a strategic asset. In conclusion, Macleod advocates for a nuanced understanding of gold and silver as forms of money with lower counterparty risk compared to credit-based investments. He highlights the legal recognition of gold as money and underscores its historical resilience as an investment asset, especially during times of economic uncertainty.